axis will increase the horsepower. That was the original vision. And the idea was you didn't have to change the percent stuff that's been taken by these Bitcoin cores. And all the original vision was kind of like good. So they have this whatever. But I didn't realize that the vision was so they've tested, they've done tests on something like and so it can reach millions of transactions. So that I didn't realize that the entire vision for Bitcoin was a single just like, this is my current understanding. I haven't done all of the research yet, but this is what I'm learning. It's totally changing my thought about crypto. You know, we have all these different points. No, there's one, because you want all of the hashing power dedicated to that one point. Because if they're separated, then you can easily hack all of them, right? So all of the hashing power dedicated to contents of the hyperspace. What it feels to me right now is that Bitcoin Cash is actually the internet protocol. Right? The internet protocol is developed as different versions, finalized on the version. How many internets are there? One is internet, because it's so easy to communicate with us. So that's why I say Bitcoin Cash is going to be the internet protocol. Great. So if you wanna, there is a chance right now, I believe, if it doesn't get pumped out, for a second coming for MJ. Huh? Yeah, but you have to be really careful because obviously there's a lot of manipulation. There's Bitcoin board manipulated in order to slow down the adoption. It's crazy. I mean, that's obvious that some people's money interested do that. But there's still a chance to be one of the first people to develop a market. Even though there's still a chance to be first. It's pretty exciting. No, they're not open to changing it. They want to revert exactly to the protocol that Satoshi described. The main Bitcoin protocol has. Oh yeah, it's right here. Cares. They're not firewalling Bitcoin, they're just not allowing exchange. But here's the point about Bitcoin. It's not because of the network, it's incentivized to connect to as many nodes as possible. So the average transaction is like takes 1.2 hops. It's so connected that all messages get sent
Hi.
How are you less than 2 hops.
Good. I'm an associate for Capital Factory's Accelerator and their venture capital fund. I'm very excited to announce Miles Snyder. He's a research associate at Multicoin Capital, a cryptocurrency hedge fund here in town. He's also the creator of the Stablecoin Index, a tool to track and compare various stablecoin projects that are both live and in development. He's going to give us an overview of stablecoins. Has anyone read his blog post before? Yeah? It's a good one. Cool. Okay, well, I'm going to hand it over to Miles right now. Thanks so much.
Thank you, everybody. Thanks for coming out. So as can you zoom this up a little?
Yep.
As Kelsey mentioned, I am a research associate at Multicoin Capital, which is a crypto hedge fund that is based here in Austin, formerly actually based out of Capital Factory. So a little bit about my background. I got into crypto in 2014 when I was studying abroad in Argentina. That's where I first found out about Bitcoin. And it was in the midst of a currency crisis that was happening in Argentina, where a lot of people, the local currency, the peso, had been devalued, and a lot of people in Argentina were much more interested in purchasing and owning dollars. And the government put caps on the amount of dollars that people were allowed to purchase legally. So there was a huge black market for dollars that people would literally just go onto the street and you'd trade dollars for pesos. And a lot of the Argentines I knew actually preferred to keep physical either dollars or euros in cash, in mattresses and things like that, rather than holding pesos in a bank account because inflation was really high and the currency had been devalued, things like that. So finding out about Bitcoin in the midst of experiencing that, and I would go and buy pesos every week with dollars. It was really interesting to find out about cryptocurrencies and sort of go down that rabbit hole because I immediately started to see the appeal of a non-governmental, borderless, digital peer-to-peer currency that wasn't subject to crazy hyperinflation because of mismanagement by central banks. But then the other interesting thing was that meeting all these people in Argentina who were interested in Bitcoin and talking to other people who didn't know that much about it. Bitcoin has always been very volatile, but especially at that time it was probably even more volatile than it is today. And so for a lot of people it didn't make sense to hedge against the inflation of the peso with Bitcoin because Bitcoin itself was just too volatile. And so amidst all that, I started hearing about this idea of stable coins, which is the idea that you have a cryptocurrency that's actually pegged to the value of a fiat currency like the dollar. And that was really appealing because you retain all of these properties that make cryptocurrency so interesting. The fact that they're permissionless and borderless and digital and peer-to-peer. They can be custodied very securely, much more so than cash. They can be transported more securely, but also has the value stability of fiat currencies that people were so interested in. So that was in 2014, and there were a couple stablecoin projects at the time, and I just started to read about them, learn about the different mechanics for achieving stability, and became really interested in them. Kind of became like a interest of mine. And at the time there was one called Nubits that ultimately became a failed project. That peg actually completely failed. There was one called BitShares that's still around today that's got BitUSD, BitCNY, BitEuro, that are all stablecoins pegged to different fiat currencies. And then Tether came around as well. But then in 2017, or I should say, then there was another project called Maker that came about a year later. And then in 2017, the idea of stablecoins really, I would say, went mainstream, and we saw an explosion of different stablecoin projects. So as Kelsey mentioned, I have a website called the Stablecoin Index where I keep track of different stablecoins that are live and their prices and things like that. And also I maintain a list of all the stablecoin projects that I know about. And I think the last time I checked, there was like between 25 and 30 different stablecoin projects in development. And I get emails like every other week at least with a new project that's coming up. So I'm going to sort of run through the different, there's kind of three basic designs for stablecoins. Some of the new projects I'm seeing are using hybrid designs, but they're still kind of conform to these three basic parameters. But yeah, to go back to the basics, a stablecoin is a cryptocurrency that's designed to be price stable. Almost all of the ones that we see are pegged to the value of $1, but theoretically they can be pegged to other things, other fiat currencies like CNY or the euro, and even like precious metals, like stuff that's pegged to gold. And so as we know, a currency is designed to be a medium of exchange, a unit of account, and a store of value. And Bitcoin is attempting to sort of take this ground up sound money approach to redefining money. Whereas stablecoins are basically saying, let's borrow this unit of account that people are already familiar with the dollar, and then design a cryptocurrency that has those other properties, but maintains that unit of account. And that is, it's helpful because one, the dollar is relatively stable and useful for most people, but it's also a unit of account that people are already familiar with. So as you try to integrate into dApps and things like that, it becomes very helpful. So, what are the uses for stablecoins? There's a lot of different ones. One is just, like a fiat alternative for countries like Argentina, Venezuela, more recently Turkey and Iran, that are experiencing hyperinflation, and you have citizens who really don't want to hold the local currencies. People are trying to get their hands on dollars or euros or other fiat currencies that are perceived to be much more strong and stable, but that can be a challenge. The demand is really high for these fiat currencies in those places. It can be difficult to get. It sometimes relies on physical transportation. Securing it can be really hard. And so when you put it in the digital realm, people could potentially park their wealth inside of these digital assets that and they can get to these people easier because they're borderless. So that's probably the sort of low-hanging fruit for stablecoins. But you could also imagine them being used for payments. If you have some stablecoins sitting in your MetaMask wallet on Ethereum or whatever other protocol you're using, it could make it really easy to purchase digital goods online, for example, without having to enter all your credit card information. Or also things like remittances, doing cross-border payments that don't rely on these expensive and slow legacy rails like SWIFT or Western Union, which often charge a lot of fees, have a lot of legal complications, and tend to just be really slow. Trading pair, we'll talk about Tether, which is one of the biggest stablecoins in existence that's mostly used for cryptocurrency traders as a trading pair or somewhere where they can have a stable place where they can park wealth as they move into and out of positions. And then finally, one of the really interesting use cases, especially for decentralized stablecoins, is as a unit of account within decentralized applications. So on Ethereum and EOS and Stellar and some of these other projects that are coming online, over the course of the next year or so, a lot of these protocols are designed to be platforms for decentralized applications. And you have things like loans and derivatives and prediction markets and insurance and all of these things that involve contracts that last over time. And it's really useful to have a stable unit of value that you can use in those. So for example, Augur is a prediction market that's built on Ethereum where people can place bets on basically anything. But you can imagine if you're betting on a sports match and the bet is denominated in Ether, even if you win the bet because you're correct about the sports match, if the price of Ether has fluctuated significantly during the time that the bet took place, you could end up losing money. Whereas if you could denominate those things in dollars, then it becomes a lot easier. And it also is really helpful for when you think about onboarding users, because right now there's sort of like, crypto is this insular community of people who are crypto native and often very technical and things like that. But as we try to create dApps that onboard the next generation of users who's not yet familiar with crypto, giving them a unit of account that they're familiar with that they can transact in while using dApps, I think is going to make that onboarding process a lot smoother. Okay, so now I'm going to talk about the three major categories of stablecoins. And so it basically falls into, there's a centralized model, which is a fiat collateralized stablecoin, just like an IOU. And then there's two decentralized models. One is a crypto collateralized stablecoin, where there's collateral held in the smart contract. And then the other is what's generally called non-collateralized stablecoins, sometimes called seigniorage shares, sometimes called the algorithmic central bank model. So we'll talk about each of these. Fiat collateralized stablecoins, so far they've been the most successful model, with Tether being the sort of prime example there. Tether is has a market cap of over $2 billion. But these are definitely sort of the least interesting model because they're centralized. Basically what they are is that some party holds fiat currencies in a bank account somewhere and issues a token that's an IOU on those currencies. And so this model is reliant on that third party to be honest about what they've got in their reserves, to honor those IOUs. Basically, you're trusting them not to lie to you. And as we've seen with Tether, if anyone's been paying attention over the last year or so, there's been a ton of controversy around this project because they've got $2 billion worth of stablecoins outstanding. No one knows where they bank. No one knows who their bank is. To be honest, no one knows if the stablecoins are fully collateralized or if they're running a fractional reserve or some sort of just massive fraud. And there's a lot of speculation around it. And the team behind Tether really has not done a good job of assuaging any of those concerns. So we've seen a couple alternatives pop up, the first of which is called TrueUSD. They're a US-based company with banks here. They are going to be continuously audited. They're following all these pre-existing legal frameworks, and they're attempting to basically offer the same product that Tether is offering, but with much more transparency. And then as of more recently, Circle and IBM, in partnership with a venture fund that is focused on the Stellar blockchain, both announced that they're going to do fiat-backed stablecoins. And then there's also a project called Digits, which technically isn't a fiat-backed stablecoin, but they do the same thing using gold bars that are held as collateral. So the tokens are an IOU for the gold that's held in the account. So you could imagine this being done with a lot of different things, but the most common is $1. Why? Because it's, as I said, a unit of account that everyone's familiar with. So the first decentralized stablecoin model is what we call a crypto collateralized stablecoin. So projects like Maker, BitShares, Haven, these all run on this model. And essentially what it is you take collateral in the form of crypto assets, so we'll just use Ether as an example, and that Ether is locked up in a smart contract, and then stablecoins are issued as debt against that collateral that's held in the smart contract. And the tokens, the stablecoins, are a claim on a certain dollar amount of what's held in that smart contract, and they're redeemable for that. And because they're all a claim on the same dollar amount, no matter which smart contract it is, or no matter technically what type of collateral it is, those debt tokens, which are the stablecoin, are all fungible. So you can imagine someone locking up, $200 worth of Ether in a smart contract. The system issues $100 worth of stablecoins, and those stablecoins basically function as a claim on $100 worth of that $200 collateral. So why do you have to lock up $200 worth of collateral? Well, basically, as we all know, cryptocurrencies fluctuate a lot in value. So you want the collateralized debt position or the smart contract to be very strongly over-collateralized, so that even if there's fluctuations in the amount of value, in the value of that Ether that's held in the smart contract, those that $100 debt is still covered. Does that make sense? I don't know if I'm explaining that perfectly. Okay. So one of the issues here is that the incentive to actually go out and create the stablecoins is not necessarily in line with the demand for stablecoins. Because what happens is if you take the incentive to actually open up a collateralized debt position and put Ether into one of these smart contracts in exchange for stablecoins, there's really two reasons why you do it. The first is to get leverage. You can basically put a certain amount of Ether in the smart contract, your issued stablecoins, you can go sell those stablecoins for more Ether, and now you have a leveraged exposure to Ether. Or maybe you just want a loan or sort of liquidity. So you put some Ether in a smart contract and you get out some DAI, and that way you can sort of get some stable spending money using your crypto as collateral without necessarily selling that crypto. But those two things are very independent of the demand for stablecoins. So the sort of like the demand for people who want to use stablecoins is different from the demand for people who either want to take out leverage or take out loans. So as the system scales, it becomes somewhat difficult as those two things sort of diverge. With this model, currently the most prominent project is Maker, which offers the ability to use Ether as collateral. And they're moving towards a model in which they'll offer all sorts of different crypto assets as collateral. I think the first one they're going to do is Omise Go, which is another token that's issued on Ethereum. And then they're also thinking about actually using Digix, the gold-backed stablecoin that I mentioned. But they're also thinking about moving into security tokens territory. So for those of you who don't know, security tokens are tokenized representations of real world assets, whether it's a tokenized representation of real estate or just a tokenized version of equity, so like Apple stock on the blockchain. And the reason those are interesting to use as collateral is because one, they're generally much more stable than crypto assets. And two, if you can use things like real estate and equity as collateral in these smart contracts, it gives you a lot more room for growth of the total stablecoin supply than just using Ether. Because as we said, these CDPs have to be over collateralized. So if you have $100 million worth of the stablecoin that's issued, that requires at least $200 million worth of Ether that's held up, that's locked up in the smart contract. So it's not very capital efficient. If you were to use tokenized securities, you could theoretically have a lower collateral ratio because these things are generally much more stable, but you also just get access to, a significantly more, bigger amount of value than you were if you were just using Ethereum, or Ether, I should say. So there's obviously advantages and disadvantages to this model. The advantage is that it's in my opinion, the most robust decentralized stablecoin model. I think if you're just talking about what is going to be the most price stable, it's probably going to be this model because the stablecoin always has a price floor because there's a claim on the amount of collateral that's in that smart contract. And that smart contract exists on chain, so it's always publicly auditable. So you know exactly how much collateral is backing the stablecoin. And even if the value falls, you have that buffer there. And so you're never going to get a situation in which the stablecoin value falls, below what it's redeemable for, because arbitrageurs would come in and buy it up, redeem it for the collateral, and make that spread. So I think that the spreads around collateralized stablecoins are going to be much more tight than the other model that we're going to talk about next. The disadvantage, obviously, is that it's not capital efficient and that the supply and demand curves don't really intersect at any point. So it doesn't scale well. This is just a representation of a CDP, and then this is actually what happens when these CDPs go underwater. I'm not going to really go into this, but basically these smart contracts are programmatically liquidated by the Maker protocol when the collateral drops below a certain ratio, and that basically protects them from just going completely bust in the event that the price falls. If you're interested in learning more about that, Maker's got a lot of resources on their website that talks about how liquidations actually happen. It can get pretty technical, but it is very interesting. So finally, the third model is what we call non-collateralized stablecoins. So this model started with a guy named Robert Sams who wrote a paper called Seigniorage Shares, but it wasn't actually implemented, or no one actually tried to build a version of Seigniorage Shares until 2017 when a project called Basecoin came along. Basecoin is now known as Basis, and they were the first Seigniorage Shares stablecoin, and now there's quite a few other projects that are using the same model. So this is a very different and interesting model, and I'm going to do my best to explain how it works. But the reason it's called an algorithmic central bank is because it essentially attempts to mimic what a central bank does in a completely programmatic way, and kind of mimics fiat on a blockchain. So non-collateralized stablecoins are not actually backed by anything, meaning there's no collateral backing the stablecoin. And so what happens is you issue the protocol to begin with issues a certain amount of stablecoins. So there's, call it 100 stablecoins in existence. And if demand for that stablecoin goes up, if the supply stays fixed and demand goes up, then the price of the stablecoin is going to go up. So what it does is when that happens, when demand goes up, it actually increases the supply of the stablecoin to keep the price relatively stable. And then if demand goes down, it contracts the supply of the stablecoin in order to keep the price at the peg. And this is, it uses what's called the quantity theory of money, which is what a lot of central banks use to try to keep their fiat currency stable. The sort of problem and like the bootstrapping issue here is that because it's not actually backed by anything, you have to get all of these people who are participating in the protocol to sort of collectively agree, hey, this thing should be worth $1. And once everyone has that shared belief, then you can kind of get people to play this game. But bootstrapping that belief is going to be an incredibly hard challenge for these stablecoin projects. And one of the reasons that I say that it sort of attempts to mimic fiat on chain is that, as we all probably know, fiat currencies aren't backed by anything either. The dollar isn't actually backed by gold anymore like it used to be. There's no collateral that's keeping it at its price. It's really sort of managed by these central banks that use the quantity theory of money in addition to some other techniques to try to keep the price relatively stable. The thinking behind senior shares stablecoins is that if this can be done in a way that is completely programmatic, you take out some of that human error that has caused so many fiat currencies to become unstable. So if we're talking about Argentina or Venezuela, like some of the examples that I gave earlier, the central bankers just couldn't help themselves and ended up printing a lot more money. And we've seen that over and over and over again. What this says is that no, we're gonna program the ability to increase the supply or decrease the supply into the protocol, but it's all those parameters are going to be built in and they can't be sort of corruptible by humans. I consider this to be by far the most ambitious and experimental type of stablecoin. Personally, I'm not convinced that it's going to work. I think there's a lot of issues with it, but I am interested to watch it play out in practice. Probably sometime in 2019, we'll see Basis debut. I think they'll be the first to come out, so we are going to see this in practice. But one of the other interesting things here is that if you have this program that's trying to increase or decrease the supply of the stablecoin, how does it actually do that? So if you want to increase the supply of the stablecoin, it's really, really easy. All the protocol has to do is print more money, right? But then the question becomes, who does that money go to? So what they do in stablecoins is they create this system of shares that are essentially equity in the growth of the protocol. And people who own shares get a pro rata distribution of the newly minted stablecoins. And that's why it's called seigniorage shares. Seigniorage is a name for the sort of profit the government makes by spending money. So this protocol securitizes seigniorage and gives it to anyone who owns these shares. So, but increasing the supply is the easy part. Then when you have to contract the supply of the stablecoins, how do you do that? And it's a lot harder to decide, who is this money taken from or how is it contracted than it is to just print money and give it to everyone who owns shares. So what Basis came up with is a system that they call bonds. They're not really bonds, they're more like these binary options. But essentially what it is that if the system wants to contract the supply of the stablecoin, they sell these bonds that are a claim on a future payout. So for example, you may buy a bond for 90 cents, and in the future it will pay you out one stablecoin at $1. And so what you're doing is you're basically giving money back to the protocol that's burned or taken out of the supply in exchange for a claim on a future payout. It's kind of an interesting system, but there's a few major issues with it. The first is that it relies on this idea of perpetual growth because the supply never actually contracts with finality. All that it does is issue claims on future supply growth. And in theory, that just requires perpetual growth for the system. So one of the things that the Basis team has done is they said that after 5 years, bonds expire. So if you buy a bond and it doesn't pay out within 5 years, then you get nothing. So that makes it even riskier, but it also, like I said, it makes it, these things aren't really, they're not really bonds, they're sort of binary options with a potential future payout. One of the other issues is that bonds get paid out on a first in, first out basis. So if the protocol decides to contract the supply and it starts offering bonds, and I'm the first person who purchases a bond, then when they must grow the supply in the future, I'm the first person that gets paid out. And all of the bondholders get paid out before the shareholders get paid out. Shareholders only get paid when the system increases the supply so much that it pays out all the existing bondholders and then goes on to pay out the shareholders. However, what this means is that bonds aren't all valued the same. Because if I'm the first person who buys a bond versus if I'm the 500th person that buys a bond, at 500 I'm going to be it's a lot less likely that I get paid out. And so the bonds aren't really fungible, and they're not going to be priced the same. The other thing is that as the bond queue grows longer, the price of bonds has to go down in order to compensate people who are taking on bigger risk. If I'm number 500 in line, I'm taking on a much bigger risk than the guy who's first in line. And so what happens is that as the system has to contract the supply more and more, it has to issue more bonds. But every bond it issues has to be sold at a slightly lower price than the bonds before that. And because it's being sold at a slightly lower price, it's taking slightly less money out of circulation. And you can imagine that eventually this leads into this death spiral on the price of bonds, where they're trying to take out money out of circulation, but they have to keep decreasing the price of bonds and thus keep issuing more bonds in order to take the same amount of money out of circulation. That's a really big problem for these protocols, and I haven't really seen a good solution for it. The basis team solution is that essentially they say at a certain point the protocol is going to stop paying out bonds. It's kind of going to let the peg, let the stablecoin depeg for a little bit, and then once the bond queue or once bonds start paying out again, it'll repeg. I don't necessarily believe that to be the case. And then finally, there's an attack called the Soros attack that I'll go into in a second. When we look at this model, the advantages are that it's algorithmic. The protocol has a single mandate, which is keep the price of the stablecoin at $1, versus the central bank, which has a lot more to worry about than simply keeping the price stable. And then the other thing is that it sort of takes out this layer of human involvement. It also scales really easily. As we mentioned, with the collateral-backed stablecoins, you definitely have a kind of a ceiling on how many of those can get issued, whereas theoretically with a algorithmic stablecoin, that could scale to as big as it can possibly get. As many people are willing to join in on this shared belief that this thing should be worth $1. The disadvantage is that it's not backed by anything. So as I mentioned, with the collateral-backed stablecoin, there's a price floor on that because of whatever is locked in the collateral. The value of the stablecoin is never going to go beneath what is available as collateral, because smart arbitrageurs will step in and buy that up and return it to the peg. Whereas with senior shared stablecoins, in a crisis of confidence, there's nothing preventing this from theoretically going to zero, completely depegging. As I mentioned before, it relies on perpetual growth, and if you can't have that, then you have to put in these artificial constraints like Basis did. The other thing is that it can't be audited. So the crypto collateralized stablecoins, everything that happens in that protocol is completely transparent and on-chain. You can audit it. Whereas with the senior shared stablecoin, you never really know what it would take to break the thing, or how much money is willing to step in to support the peg, because all of that takes place off-chain, or the vast majority of it. So then finally, there's what's called the Soros attack. And this sort of is an exploit on the fact that it's really easy to increase the supply and hard to contract it. So it's called the Soros attack because it's based on George Soros's sort of infamous breaking of the Bank of England. And the idea here is that some investor takes out a large short on the stablecoin itself. So they purchase the stablecoin at $1 and they sell it off, and either just in the process of selling it off, or through some sort of PR campaign attempting to break confidence in the system, they try to get the peg to break and the stablecoin to fall below the peg. Then they can cover their short at a much lower price and make a profit. So for example, if they purchase the stablecoin at $1, sell it off, then there's some crisis of confidence and the peg falls down to, say, 70 cents, they cover it 70 cents and then they make that 30% spread. It's not quite that simple with slippage and a lot of other factors, but that's just generally speaking. The reason this is kind of an interesting attack is because if you are the Soros attacker, traditionally, when you take out a short in like an equities market, the worst thing that can happen is that you get short squeezed and the position just moves against you. With this, that's practically impossible because you're taking out the short at $1, and it's very unlikely that the price of the stablecoin ever goes above $1, because if it does, the protocol just begins minting new stablecoins and starts helping you out. So the risk that you're taking on is really just the cost of securing that borrow and potentially the slippage as you move into and out of that position. But you could certainly see how with that kind of asymmetric upside and protection on the downside, a lot of investors would be really interested in trying to execute this attack. And I've actually talked to crypto hedge fund managers who are already thinking about how they're going to go about coordinating a Soros attack and working with other funds to do it. And yeah, so there are some mitigations here, and some of these protocols are attempting to put things in place like having collateral reserves on chain that will step in and buy bonds and things like that. But it's still a pretty sticky issue. So one of the other challenges that all these decentralized stablecoin projects face is what's called the Oracle problem. So when you have these protocols that are trying to peg to the value of $1, you basically have this data that exists off-chain that you're trying to get on-chain. Because the protocol doesn't know anything about the outside world, and that's what an oracle is. It's something that takes information from the outside world and brings it onto the blockchain. So the protocol itself doesn't necessarily know what the price of the stablecoin versus the US dollar that it's trying to peg to is. But if the protocol is going to change the supply in response to that, then it has to know that information. Or if the protocol is deciding, are these CDPs properly collateralized? Are we good? Thank you. They need to know the value of the collateral that's in the CDP. So basically all of these protocols need a way to get that off-chain information on-chain. And because that is a really tough problem, it's kind of been called the Achilles heel of some of these stablecoin projects. And there's only a few ways to do this that people have come up with so far. So the first is just to have a centralized oracle that feeds the information, takes the price feed off-chain and feeds it on-chain. The problem is that's centralized and it kind of defeats the whole purpose of having a decentralized stablecoin in the first place. And it also becomes a central point of attack. Another way to do it is to have basically people who own equity in the protocol, so in the senior shares, like the people who are the shareholders, could vote on a set of delegates who are elected to provide price feeds, and then you collect the price from all of those delegates, you take the median of it so that even if one gives you some crazy price, it doesn't ruin the whole thing. And that's what you use as your price feed. And those delegates can be voted out by the shareholders, voted in or out by the shareholders if they provide faulty information. That's a system that's currently in place with BitShares, and I believe that Maker is moving towards that model. And then there's finally what's called the showing point scheme, which is basically you have all the shareholders vote on, they basically put inputs in of what the price is, and those who are in within the 25th and the 75th percentile are rewarded, and those who are outside of that range are slashed. They have to put up a deposit in order to make a prediction, and that basically uses game theory to get all these people to say, well, the truth is probably the best option, because if everyone else is voting on what the real price is, then I should vote on what the real price is, because then I'll be within that median range. It's a really interesting scheme. I think that Vitalik Buterin from Ethereum was the first to formalize it, but I could be wrong there. He definitely has sort of the canonical blog post about this. The problem is we haven't really seen this at scale. A lot of the stablecoin projects that I've seen are saying this is what we're going to use for our price feed, but we're not really sure how this works in practice. And the reason that for all of these things it's called the Achilles heel of a stablecoin is that if you can corrupt the price feed, you can break the stablecoin, break the entire protocol in any number of ways. Certainly if you were a Soros attacker and you knew that you could corrupt the price feed, that's a very strong incentive to do so. So it's almost like a stablecoin is only as robust as its oracle system is decentralized. This is a diagram that my friend Haseeb Qureshi made. He has a really good article on stablecoins that's linked on the website that I'll show you guys at the end. But this sort of talks about the different trade-offs between the various models. In the top left corner is Tether, top right corner is DAI, which is Maker, and then at the bottom is Basis. So with the non-collateralized stablecoins, they're very capital efficient and they're decentralized. The crypto collateralized stablecoins are decentralized, and they have this collateral which provides a price floor and kind of provides more robustness. And then the fiat collateralized stablecoins are more capital efficient, and they're collateralized, but they are centralized. I think that's a pretty interesting way of thinking about the trade-offs here. So there's a few sort of remaining issues and other things I wanted to talk about regarding the future of stablecoins. One is that some people think that pegging to $1 is not necessarily the best long-term option for stablecoins. There's a lot of people, especially in the crypto space, who don't have a lot of confidence in the future of the U.S. dollar and think that that price may go down in the future, or sorry, the value of the U.S. dollar may fall significantly in the future. But also by pegging to the price of $1, you inherit the dollar's annual inflation as well. So some of these stablecoins that are very ambitious, like Basis, for example, have plans to eventually move from pegging to $1 to pegging to a consumer price index to sort of give this global value stable purchasing power that doesn't actually rely on any pegging to a fiat currency of any central bank. Because if the idea is to create an algorithmic central bank that avoids some of the human errors of, say, the U.S. Federal Reserve, but you're pegging to the dollar, which is controlled by the U.S. Federal Reserve, then it becomes kind of reductive. However, how you go from pegging to $1 to pegging to a consumer price index is a question for the future that hasn't really been answered well, and there's probably going to be a lot of complications with that. And then we've seen stablecoins run into a lot of issues around scalability. So there's the scalability of the collateral requirements, which I talked about before, but there's also just performance scalability. Some of the, most of the blockchain platforms upon which these things are built, the vast majority of them that exist today are built on Ethereum, which in its current form just does not scale well. It maxes out at about 15 transactions per second, and for a global digital version of cash, that is simply not enough. So any stablecoin that's built on a smart contract platform is kind of bottlenecked by the scalability of that platform. And so we're seeing a lot of them run into issues with that. And until these platforms can scale, then these stablecoins are going to be unable to scale as well. And then another thing, specifically in regards to a project like Maker, is this social scalability aspect. So what Maker does is they have basically an equity token that is equity in this protocol that not only allows you to receive fees from when people close out their positions, when they close out their CDPs, they have to pay a fee that is distributed to all the Maker token holders. But the token holders also get voting rights, so they can have input on the governance of this project. And there's a lot of different parameters that the token holders have to decide on. So for example, what types of assets can be used as collateral? What is the collateral ratio that's required? At what ratio does the CDP get liquidated? What is the stability fee that's paid when people close out their CDPs? There's all these questions, and those things may be different for each type of collateral. And that requires a lot of human input, it requires a lot of expertise, and it remains to be seen whether that system can sort of grow and scale to this global protocol when it requires so much human input. One of the advantages of the algorithmic model is that it's kind of set it and forget it. The parameters are coded into the protocol. That's more of a hard code approach, whereas Maker is taking what some people call a wet code approach that requires a lot of human input, and you run into a lot of issues there. Finally, I think that privacy is something that not a lot of these stablecoin projects have explored. If you're attempting to sort of be a digital version of cash, it's really nice to have privacy guarantees as well. Not a lot of people care about privacy per se, as we've seen with a lot of way that people share data on Facebook and other social networks, but businesses certainly care about privacy. And when you're built on a blockchain like Ethereum that is completely transparent and every transaction is logged and auditable, there's firms now that can do blockchain data analysis. They can tie addresses to real world personas. They can do, they can gain a lot of information from just looking at the blockchain. And you don't, if you're a business, you want to protect your business relationships. You don't necessarily want people to know who you're paying, what you're paying, who you're doing business with, things like that. So even if privacy is not a concern for users today, I think in the future it will be. And thus far, none of these stablecoin projects have really found good ways to implement privacy. And similar to the scalability issue, they're going to be bottlenecked by the privacy sort of features of the protocol that they're built upon. And then, so I mentioned some attack vectors before. I also have here the Lindy effect, which is the Lindy effect is basically this idea that the longer something's been around, the longer people perceive that it will be around. It's often one of the arguments that people give in favor of Bitcoin is that, every year that Bitcoin survives, people have better expectations about its future survival. And I think that's really interesting when it comes to stablecoins, because the longer something that's a stablecoin is in existence and maintains a good peg and is actually stable, it's going to have a lot of advantages over some of these new stablecoins. So right now, there's only a few stablecoins that are actually live, and some of these other ones that are being built are going to have a tough time competing if they debut, say, a year from now, and Maker's DAI stablecoin has been around for a year and has been stable. Because if you're a user and you're deciding which to use, would you go with the new one or the one that's more proven? And then finally, there's this idea that stablecoins, or at least decentralized stablecoins, will get eaten from above and below, which is the idea that some people think that some governments are eventually just going to issue fiat currencies on a blockchain. And as we know, a lot of people don't really have problems with fiat currencies, especially in countries that haven't experienced hyperinflation, and they'd be more than happy to, they're more than happy to continue using dollars or euros or whatever it is that their government currency is, and don't really have an interest in a decentralized currency because it doesn't bring that much to the table for them. And so that would sort of cut, if a government did that, it would cut out some of the potential demand for a decentralized stablecoin. And then when people say it would get eaten from above, there's a lot of people who think that Bitcoin is eventually going to become sort of the global internet currency. And it's going to do that by first being this sound money digital store of value that eventually becomes a medium of exchange and later actually a unit of account. Using things like the Lightning Network and some of these other scalability plans that are in place for Bitcoin. And if you hold that belief, then you believe that sort of eventually people are just going to denominate their transactions in Bitcoin. They're going to want to get paid in Bitcoin, and Bitcoin will sort of become the de facto currency rather than people using fiat. And so that would sort of mean that as time goes on, the demand for these decentralized stablecoins becomes less and less because people just use and pay in Bitcoin. So that's kind of everything. The one final thing that I wanted to show you guys was, so as I mentioned, I maintain a website called the Stablecoin Index. You can follow it on Twitter. It's just at Stablecoin Index. There's the front end that we have right now is really simple, but this is what we're going to be coming out with soon. I partnered with a really cool developer who works at Maker actually to create this, and it's going to be completely open source. But basically, if you're interested in stablecoins and want to check check out different stablecoins, see how they're performing, see how good their peg is, this is a good resource for you. So we've got things like market cap, trading volume, and price, and you can compare all these stablecoins. The idea behind this is that, sort of as I mentioned with things like the Lindy effect, that the good stablecoins should survive and the bad ones will eventually fall out, as we saw with a stablecoin like Nubits, its peg broke. And so this is a place to compare them all. But also, if you're interested in learning more about stablecoins, we've got this section that's, as I mentioned, all the different projects that I know of. And then over here in resources, I've got a bunch of stuff that I've collected from all around the internet that's related to stablecoins. So if you're interested in diving deeper, this is a great place to start. I've done my best to not just include explainers and like bullish takes on why stablecoins are going to be the greatest thing since sliced bread, but also some really bearish takes. There's a lot of people out there, sort of economists and crypto commentators and other people who think these things absolutely will not work, that they're terrible ideas, and you can find those articles in here too and sort of decide for yourself. So that's everything. If anyone has any questions, we can launch into Q&A.
Yeah, with something like TrueUSD, where they have to deal with paying for audits and banking relationships and all that, what's their incentive to make a digital dollar for a real dollar?
Miles, if you could just repeat the question back so people on the live stream can hear it.
Got it. Yeah, so the question is, with something like TrueUSD, like what is the business model there and what's their incentive to go about creating a digital dollar? From what I know about TrueUSD, they charge a fee every time that you, so if you own the stablecoin token and you want to convert it back into fiat, they charge a pretty substantial fee. It's obviously aimed at like institutional clients who are redeeming for a large amount of fiat, and that is their business model. Tether, if you believe that Tether is completely above board, which is it's totally possible, I think I've heard some people say that they believe that Tether operates at a loss, but because it's owned by Bitfinex, which is one of the biggest cryptocurrency exchanges in the world, having Tether is really good for them because a lot of traders use it and it helps their exchange business. So they may be willing to operate it at a slight loss in order to have the exchange business. But I think with things like TrueUSD and the Circle USD, the IBM USD, the business model there is to just collect fees when people go into and out of fiat.
How many of these projects are like actually following securities law?
The question was how many of these projects are actually following securities law? I have no idea. You'd have to ask the individual projects. I think some of them conducted ICOs where they sold to retail investors. Whether or not these things are securities probably depends on the mechanics of the individual token. With something like a senior shares stablecoin, as I mentioned, like the seniorage is literally securitized. That seems, likely that it could be a security. I know some of them restricted their sales to accredited investors. Probably just depends on the legitimacy of the project, and you have to go on a project by project basis. But yeah, I'm not exactly sure how to if I can answer that.
So the way you describe this, it seems like that there are a lot of functionality and vulnerabilities that are similar to fiat currency.
Mm-hmm.
So in the end, how is this better than a fiat currency? That's question number one. And then question number two, or it isn't, maybe it's just competition. But question number two is some of the concerns people have with central banks and whether, right now, US dollar is not the sole reserve currency, it's really a basket, even though it's labeled with the euro, the rupee, et cetera. And I was wondering if what we now think of as the most stable currencies become less stable, how do you foresee it impacting this?
Okay, so there were two questions there. The first is, how are these better than fiat currencies? And then the second was, as fiat currencies potentially become less stable, what happens to these things? The first is, are they better than fiat currencies? Sort of from a value stability standpoint, if they're pegged to fiat currencies, no, of course, because they're taking on the same value fluctuations that those fiat currencies may have. But they are, they are potentially better for some of these properties that I mentioned before, which is that they're borderless and permissionless and digital. They can be secured really easily without relying on a third party. You can have self-sovereign ownership of these digital assets. You can bring them anywhere in the world, and theoretically, spend them anywhere in the world that they're accepted. The other thing is that if you're comparing like the centralized stablecoin model to the decentralized model, if you have a centralized stablecoin like TrueUSD or Tether or something like that, theoretically that company could put a whitelist in place for saying the only Ethereum addresses that can hold this stablecoin are ones that have been through our KYC process or our accredited investors, whatever it may be. Whereas the decentralized stablecoins, they're completely permissionless. No one can tell you whether or not you can hold them or not. And specifically if they're used in certain types of dApps, like say an augur prediction market that's essentially gambling, that the government may not be too happy about people doing that, they can still be used without being stopped. Now to answer your second question, what happens when the value of some of these existing fiat currencies that are today considered strong start to fall? Well, it depends on what sort of the stablecoin model is. If they are pegged to those fiat currencies, then they're going to go down with those fiat currencies. If they're eventually planning to move to something like a consumer price index, which I think is Basis's plan, or Maker's plan is to move to the I think it's the IMF has a basket of currencies called special drawing rights. That's sort of a mixed basket of a lot of different fiat currencies from around the world, and they eventually want to start to peg to that. Then theoretically they could avoid some of those issues, but it still begs the question of how do you get from being pegged to a dollar to being pegged to a consumer price index. That's probably something that's really hard to execute in practice on a decentralized protocol. So I'm not exactly sure how that happens.
With your articles of reference, does anything come across about how the central banks view these cryptocurrencies? Have they gone on record at all?
So like historically, the U.S. government has not been very friendly to people who are trying to issue private or competing currencies. If you look up the Liberty Dollar, it's a good example. It's not actually the Federal Reserve that goes after them, it's the Secret Service. But I think as it stands right now, these things are just too small and insignificant to have attracted that much attention from regulators. Although I will say that Tether has gotten big enough that you would think it would have attracted more attention from regulators, and perhaps they're working behind the scenes trying to figure out what's going on there. But for a lot of these decentralized stablecoins, I just don't think they've started paying attention yet. If they do get big enough, I think regulators will start paying attention. The question becomes, are they truly sufficiently decentralized enough at that point that regulators cannot shut them down? That remains to be seen.
I'm just kind of new to this, but I'm just wondering, you had talked about some kind of tether coin, but it'd be based in the U.S. and that, I guess that'll give some people a certain sense of confidence in it. But then I think to myself, like, the government really is going to control all of this, because they're going to say at some point, like now, you deposit $10,000, you have to show that they have to have some legitimate source, money laundering issues.
Yeah.
I mean, it's kind of a chicken and eggs thing, isn't it? With this stable coin. Yeah.
So the question was in regards to fiat collateralized stablecoins, especially ones that are based here in the U.S. Yes, they definitely will have to follow AML, anti-money laundering, and KYC, know your customer laws that all sort of money transmitters and banks have to go through. However, for that particular model of stablecoin, the use cases that they're serving aren't necessarily the same use cases as the decentralized stablecoins, and thus that's not necessarily a problem for them. So you can imagine, like, traders who they're professional traders who pay their taxes and are upstanding citizens. They just use it as a trading pair because it's really useful to them. Or you could also imagine, as we're moving into a world, we're seeing companies start to issue equity on blockchains using tokenized equity, or to issue shares in a real estate investment trust on a blockchain. And so with a lot of those things, you have dividends that have to be paid out. And one way to do that is to use something like a TrueUSD to actually pay out dividends on the blockchain to shareholders. And once again, because those securities offerings already go through the existing legal framework, so the people who own them are already KYC'd and all of that, then they'd probably be happy to use TrueUSD anyway, because they're sort of acting within the existing legal frameworks. They're just utilizing these things because they're useful for certain properties that they have. Does that make sense?
So you talked about Basis, how they were probably going to start trading in 2019, and in their white paper they talk about their relationships with certain exchanges. Do you have any insight on why you think 2019?
Oh, okay. So that was just a complete guess. I know some guys from the Basis team, and they're really smart and they're working really hard and their heads down. As I mentioned before, I think it's definitely a very experimental model, but I'm kind of interested to watch it play out in practice. But I'm not an investor in Basis. I have no sort of insight into when they're going to debut or what their relationships are with exchanges. I think my guess is 2018, because I know they're in development right now. I don't think it's probably going to happen this year. Or sorry, I meant 2019. As far as exchange relationships, I'm sure those guys and every other team that's building a stablecoin has a full-time person dedicated to building exchange relationships, because getting that liquidity, getting listed on exchanges is going to be really helpful for these projects.
But they put that in their white paper.
Well, I mean, if you look at the list of Basis investors, there's a lot of people who are really connected, in the crypto industry and connected to exchanges. So, I mean, that doesn't really surprise me.
A little bit of a segue with that question. For investors who like the value proposition of stablecoins, other than Maker, where do you recommend getting exposure to this kind of subset of the asset class? Okay,
the question was for investors who are interested in stablecoins, where do I recommend getting exposure? I cannot give investment advice. This is not investment advice. My advice is to go to the stablecoin index, read all our resources, do your own research, check out some of these different projects that are listed. A lot of them have some, a lot of people, their first question when you talk about stablecoins is, well, why would you invest in a stablecoin that's pegged to $1, right? Well, you're not necessarily investing in the stablecoin. You're investing in the sort of pseudo equity token or equity token that is part of this protocol. And different stablecoin models have different ways of sort of trying to get value to accrue to those tokens. So you kind of have to go on a project by project basis.
Maybe I can ask a different version of that question.
Okay.
So, kind of looking at your posting in January just on stablecoins, how would, that there's been sort of an influx of lots of different stablecoins that have come out, some of which you look at.
Yeah.
And yet Tether is still holding sort of the large position, and it seems largely unchanged. I'm interested in what you see the trend as being this year. If you look back to sort of January to date, what's your
Yeah, I mean, I think that the decentralized stablecoin world is going to evolve a little bit slower than the centralized stablecoin world because it's a lot easier to just hold collateral in a bank, issue an IOU on that collateral, than it is to bootstrap one of these much more complex and risky systems. And so I think the growth will be a lot slower. The other thing is that there was this explosion of stablecoin ideas in 2017, but very few of them have actually debuted thus far. So we only have a few that are live that we can see examples of. I think what's going to happen over the next, call it a year to a year and a half, is a lot of these protocols are going to debut, and then we're going to have a period of time in which a lot of different decentralized stablecoins sort of compete to prove that they're robust, prove that they're the most stable, and thus accrue more value and liquidity. And at some point, it's going to become sort of a breakout trend where, I don't think it'll be a winner-take-all scenario, but I think it'll probably be a winner-take-most. The only other interesting component here is that, as it stands right now, if you want to use dApps that are built on Ethereum, you have to use a stablecoin that was built on Ethereum. So your option, right now is like Makers DAI. Whereas we're seeing other dApp ecosystems come online, like EOS, for example. And right now, there's no way to use Makers DAI on EOS. So someone's probably going to build a stablecoin on EOS. And you may see some sort of segmentation by platform. But I think the direction we're going with the tech is that eventually you'll be able to do sort of cross-chain transfers of some of these things. And once that happens, I think we'll see a little bit more consolidation.
What do you see as kind of the killer use case for a really well-adopted stablecoin in the crypto ecosystem?
Yeah, so what's the killer use case for a stablecoin in the crypto ecosystem? I think with if you had privacy features and good scalability of the underlying platform, you could have like a digital cash use case just for payments that could be really simple, and especially when you're doing online payments to other countries, that could be really useful. But I think in the near term, the sort of killer app will probably continue to be trading. We'll see decentralized stablecoins used on DEXs like ERC DEX, just integrated with DAI, which would make a stablecoin. And then I think we'll see stablecoins continue to be used on exchanges like we're seeing Tether and TrueUSD now. As these dApp ecosystems develop, I think we'll see them used as like a medium of exchange and unit of account within dApps, like I was talking about with prediction markets or insurance contracts or loans and things like that.
I'm trying to comprehend the Soros attack. I have pretty significant knowledge. I'm a trader back then and built runners for George. It was all due to leverage, and he used a significant amount of leverage from rising him from a bunch of people who short the British pound, and then all kinds of other people jumped on board shorting.
Mm-hmm.
Unless there's an ability to short a stablecoin, I don't see how the Soros attack has any viability.
You're absolutely sorry. The question was about the Soros attack, and if you don't have the ability to short the stablecoin, can that attack be executed? And the answer is absolutely not. You need a market to exist for the short. So the idea is that as some of these stablecoins come online and gain traction, there will be more of those markets available. And it doesn't necessarily have to be that the traditional companies that currently offer borrows in the stablecoin space will give you a borrow in the stablecoin. We're actually seeing some decentralized applications that allow you to take out a short, within the Ethereum protocol. So there's a project called Compound that's working on that, that's building it on Ethereum, and that could be an option as well. But I think I think currently, for example, for DAI, which is online, you do have the ability to take out a short on that. But one of the interesting things about the Soros attack is that there's going to be much more sort of liquid and big borrow markets as the protocol gets really big. And as it gets really big, it becomes a lot harder for any single attacker to break the peg. So the attack is definitely not as simplistic as I presented it to be. I was kind of offering just sort of the main idea.
Right, but anybody that would short it has no risk to the upside if they're going to automatically stabilize it. So everybody would want to short it. I mean, anybody in their right mind who would get any leverage would say, I'll sell a bazillion of these because they can't go against me because it's a stable coin. But if enough people short it, it could fall where I might make money. And so it just seems like not a realistic scenario to take place because their own protocol itself suggests that a short is always forced out of the market because the market goes higher.
Mm-hmm.
And there's no way to force them out of the market because their protocol is saying it's going to be stable. It can't go higher.
Doesn't that mean that the incentive for the attacker is very high to
Extremely high if there's a way to do it, and then if their protocol to buy them so to stabilize it from falling is implemented and has the resources to accomplish that, then it takes it away. But you know, people are giving them leverage, and they have no upside risk. They'll continue to short it until they break it.
Yeah, that's the idea behind the attack.
Right, but you know that really relies on who's going to be willing to give you leverage.
Sure.
And why? And you got to pay for leverage, although you know borrowing costs are extremely low.
Yeah, I suppose the only people who would be willing to give you a borrow are people who don't think you can break the peg. You know, because you wouldn't lend someone your stablecoins if you thought they would successfully execute the attack and make it go to zero, right?
Right.
Yeah, I mean, I think it's definitely an interesting attack. We, myself and some of my colleagues at Multicoin Capital wrote an article about the Soros attack that we're actually still working on, but should get published kind of soon, where we're going to analyze a lot of the different factors because there's a lot of different things at play there.
A lot of the things you use to describe the perfect stablecoin would also describe like the perfect money laundering instrument. Is there any way to reconcile those two?
I actually don't think that cryptocurrencies that exist on a public blockchain are good for money laundering because, as I mentioned before, everything that you do is logged on chain, and they now have sort of data analysis companies and techniques that can pretty easily tie real world identities to Bitcoin and Ethereum addresses.
But we incorporate privacy.
Oh yeah, so if you incorporate privacy, I mean that's obviously something you have to grapple with. Same thing with Zcash and Monero and some of these privacy points. That's obviously a risk there. I don't really. I'm not going to say that it's not because it certainly is. But
like 20 more minutes questions.
Okay. But yeah. Anyone else have a question?
Well, I guess I was going to ask like a very similar question, but it is about just kind of like that conflict between the privacy and the because like banks who want to issue like fiat-backed like stable currency, they want to give privacy guarantees to their customers just because that's what they currently do with fiat. But yeah, then we have like the issue with money laundering. But do all these stable currency projects, do they have their own? Do they all have their own privacy plans, or like are they relying on like the underlying blockchain's plans for privacy? Well, first of all, is FreeUSD an ERC20 token, or is that?
Yeah, it's an ERC20.
So that and Circle are both ERC20. So are they both just relying on the Ethereum privacy plans, or do they have their own?
Yeah, so the question was whether these protocols are implementing their own privacy or if they're sort of dependent on whatever privacy the underlying blockchain offers, and the answer is the latter. So Ethereum, for example, has the Ethereum Foundation has expressed its desire to implement zero-knowledge proofs at the base layer of Ethereum, which would provide the ability to have privacy in certain instances. There's a lot of like scalability issues around that. I think ability to do it exists today, but it would use up more gas than it's allowed in a block.
Ridiculously expensive.
Yeah, it's just ridiculously expensive to the point where it's untenable currently. But that's something that the Ethereum developers have expressed a strong desire to do. I haven't really seen much from these other platforms about how they're going to implement privacy, but yeah, as far as I can tell, there's no way for like a protocol that's built on top of Ethereum to have privacy guarantees that Ethereum itself does not. Kelsey.
Outside of stablecoins and EOS, what are you really excited about?
Yeah, so the question was outside of stablecoins and EOS, which is another protocol that I'm very interested in. What else am I interested in the space? Honestly, Bitcoin. I definitely sort of, for a while, I think moved away from Bitcoin and became much more interested in this idea of like, a world computer, Web 3.0. But as of more recently, I've come back around to this vision for Bitcoin as being this sort of global sound money, really hard money. And yes, it's slow to evolve and it's not really scalable, but it's designed for ultimate decentralization. And there's a lot of really innovative stuff happening on sort of the upper layers of Bitcoin. So I've learned a lot more. different thing. But
finite money supply of Bitcoin make it kind of inaccessible and unrealistic for the rest of the
yeah. So the other question was whether Bitcoin's finite money supply basically will cause issues. So I think the answer is that we don't know yet. So eventually Bitcoin is going to stop, the protocol is going to stop printing new Bitcoin, and currently miners are incentivized to mine blocks on the Bitcoin network because they're rewarded with the newly minted Bitcoin. And they're also rewarded with all the transaction fees that have taken place in that block that they mine. Eventually there's no longer going to be block rewards because the supply is finite, meaning that miners are going to have to subsist on transaction fees alone. We don't really know what that's going to do for miner incentives, and we don't know what that's going to do for transaction fees. The sort of most likely scenario is that transaction fees on the base layer of Bitcoin become extremely high, and that it's really just used as this settlement layer for only the most important 300,000 transactions that take place every day, because that's how many transactions it can handle currently. Now, there are some things being worked on to increase base layer scalability for Bitcoin, a lot of like data compression stuff to sort of make more data fit into these blocks, and then I think eventually the block size will be increased, very slowly probably, given how contentious that is. But as I was saying, that like one of the reasons I'm really interested in Bitcoin a lot is because I've studied the Lightning Network, and there's a lot of innovation taking place there that can bring a lot of really interesting scalability features to Bitcoin. And then I've also seen a lot of work being done on privacy for Bitcoin. So ways of configuring wallets and configuring nodes that really give Bitcoin much better privacy features than it traditionally has had. I think it remains to be seen whether Bitcoin can have good enough privacy to the point where things like Zcash and Monero cease to be really interesting. But I'm seeing a lot of progress on that front.
What actually interests you about EOS?
Ooh, I think we'll have to do another one of these about EOS. But I would say overall, it's like from a usability perspective, it's really scalable. It the token model is such that users aren't paying for individual transactions. There's a really low latency, human readable account names, account permissions, all these things that I think make EOS one of the platforms that's most likely to have use cases built on top of it that can track the next wave of users who aren't going to know how to input a public key and send money to that address and be willing to pay $1.50 to do so and wait 10 minutes for it to get confirmed and all of that. So I think there's a lot of low-hanging fruit on the dApp side of things that I think EOS is right to take over.
2 or 3 more questions.
Okay. Anyone has it?
There's a lot of securities on Ethereum.
Mm-hmm.
Have you seen the same thing in EOS?
The question was, there's a lot of securities tokens and activity around that on Ethereum. Are we seeing the same thing on EOS? I've seen some interest from like some enterprises that are looking at the space. Not nearly the same level of interest as with Ethereum, and certainly not the same level of infrastructure that's being built with things like Harbor and their R token standard. But I would also caveat that with saying that EOS debuted at the beginning of June. It's a much less mature ecosystem. I expect it to progress really rapidly, but no, I haven't seen the same level of interest as with Ethereum.
In countries like Argentina and Venezuela, do you think people there prefer these stable coins or more the hard money Bitcoin?
I think as it currently stands, they definitely prefer the hard money and the dollars. I think there's probably like an education and a trust barrier that's going to have to be sort of breached before people will be willing to use these things. But also, at a certain point, people they want access to things that are easy to access and are useful to them. And I think stablecoins could be that in a lot of situations. So we'll see.
Well,
all right, I think that's everything. Yeah, thank you guys.
I agree with a lot of what he said. Well, it's all about regulation stuff and more both, the regulatory and non-regulatory side, so we're okay with that. Well, I'm all used for things outside of there are for the cross-chain alliance. They're very big projects. They're doing it right. My co-founder actually invested in Okay. There's a lot to do with the voting and the influence too. It's coming from one of the she's like, yep. I don't think they know about that because this came from Frankfurt Lab. They're like the top 30 now, but they all they're very pissed off at them. That's the problem. You fall in the leaders. So, chaos is happening. It's forced them to talk about it. So they switch to the backup. They already know what backup is because they already have that kind of points. So the problem is that the chaos is happening. So these are things I have that's a little arbitration requires 3 people. So it takes a lot of the system which I think is interesting post-abortionist. But nothing prevents a guy from taking out I pay you some money and I get a bad service. I'm asking them to return the money and you refuse, I can go to a third-party arbitration. It's like that scale with the 50,000 guys, 3 rounds assigned to New York case. They agree with me. They force you to send money or shut everything down. The problem is, why can't they make their money way before the first? They ship it off. That's my wealth. Unless it's such a small amount that then they can't offer it. So if I have a set of a standing system, then yes, you can shut them down. So there's an enforceability there. But if there's no reason for them to stay or it's a big down where they should have a problem with that retroactive. They're basically doing what they used to, which is I'll shoot them out of but so it'll be interesting what happens there. For anything that there's a dispute between payment service or payment product, I'm thinking no, there's nothing like a retroactive. It's forced. What it is. Get rid of that money, that cheated, stolen, whatever, and you fork and you that's what I did with basically wrote out that they have it on their list of exactly.
I'll buy a ticket or whatever it is. I don't mind having an airport. I'm very What's your ball in? What's your ball in? Okay. Oh, great. You're doing the Tuesday night appointment yet? Tuesday night appointment, which is good. Well, Tuesday's good. They'll go anywhere from 10 people to 100 people. Based on the price of Bitcoin. But honestly, it's really not we maintain it. Someone else maintains it. Once you get access to software, there's a secure hardware encryption capability on Microsoft, which means I literally have to take your device and go back into it. I can't be a Russian, I can't be an Eaton hacker, you can come into your other apps like your phone, but you give an app that's localized to the hardware element of that phone, they can take it with it, they can't encrypt it. Because the 512 encryption that we're using requires that hardware element of the phone to be encrypted. It will take, don't quote me on this, but most guys says about 1,000 years of encryption to actually pull it out. By then you're going to be gone. Right, well, actually we're talking to a guy about that next level. Very good at the so comes here, and they're already quality certified. So they have government sponsorships on top of it. So we're interested in us. But guess what? Bitcoin goes down and Ethereum goes down as soon as that happens too. So you have to change the SHA protocol to something that's talking about cryptography.
We just moved on coming back, so
The problem is that, this file here, a friend of mine had like a double listing for me in her contacts, with the wrong info on it, which by the way happened to some of my contacts when Facebook insisted on knowing my mobile number, or else they wouldn't check out somebody who I thought was duplicating my Facebook name. Yeah, this happened years ago. They just read everything.
Yeah, with the data list
I know, I was about to say. Okay. I have, and I probably look at that website. All right, well, thanks. Hi.
You gotta bring it back. Really hard. You have to have a lot of transactions to be able to kind of work it. Alright, we'll see you next time.
Yeah, we've seen it.
Lost.
this is my gig. So I don't feel like you most days. Most people. This is you're
We all organize events. I'm the meetup organizer. My job is to organizer. Also, I have no ego about this. I just like don't want to be someone, you know?
Maybe, but I can't remember. Well, that's cool. Did you have a good time? You might see my post in Slack conversations. Oh, thanks.
Nope, I've got all this.
You sure?
Okay. It's just like little stuff. Swan, I'm really cool with him. So I'll let him wrap up, and then we've got e-commerce upstairs that I've got to go check on. So
awesome.
Yeah, literally.